All right, guys, I'm Big Mike. Like always, I'd like to thank you for being here today. Today we welcome back FuturesTrader71 for another Ask Me Anything session. The sessions are 30 minutes in length. There's no prepared presentation. We just get started right with the questions. The recording for this was posted in the AMA thread on BMT a couple of hours after the event. If you need help finding that thread, just go to BMT and in the search bar type in AMA space FT71 and that'll take you to it. All right, guys, go ahead and start asking your questions, and I'm going to turn things over to FuturesTrader71. All right, FT, you should have control.
Good morning.
Hey, how's it going over there?
Good. Just 1 second. You know, if your computer ever asks you if you want to update Java or anything 2 minutes, 2 minutes before the before some pre-designated webinar, you should probably pass on that. I didn't. Hang on. I just need to read this disclaimer real quick. Trading futures and options on futures and foreign currency involves substantial risk of loss that is not suitable for all investors. Past performance is not indicative of future results. The information provided is for educational purposes only. Verify the information provided before trading on it.
All right. All right, guys, so go ahead and start typing your questions, and let's see what we've got so far. Rex wants to know, when price gets to a low volume node that is looking to fade, and instead of quickly rejecting it, it starts consolidating sideways, should he be concerned? And the same thing for when price gets to a low volume node. Oh, I'm sorry, he just repeated it. So yeah, he wants to know, should that be a concern of his?
Yeah, so a low volume node, just for definition, is a price. This is a volume histogram here. For those who haven't seen one, this is a volume profile. All this is showing is how much volume there is at any given price. So if I click on the frame of this volume profile, it shows me exactly how many contracts traded at each price. But you see this 3,260 contracts traded here at 91. This is day session only. That's called a low volume node. That means it's a spot on the profile where there's very, very little volume. Low volume nodes represent disinterest by the market. It's the old hey, this price is unfair, I'm not interested in trading here, it's either too expensive or too cheap. The market tends to move away from those prices very quickly, leaving no volume behind. You'll see those at blow-off tops. You'll see those in areas where the market traded sideways and then it breaks out. So if we look at a breakout day, you'll see that we haven't had a clean one for a while, but you'll see like the market, like this one here, traded for a while in this range and then it broke lower back into this morning's range, which had very little volume. It leaves a low volume node behind, okay? And those show up on 30-minute bar charts or whatever as like a 30-minute or 60-minute low. Now to answer the question, the expectation of a low volume node is that the price is again unfair. So I've been stalking the 89.50 up to 91 for a short. It got to 89.75 just now. And I'm looking for a retest of 85.25, 83, and 81.75, right below, right here. These gray lines represent areas I'm interested in. And so if it came up to 91 and it started to chop through it, well, what that's telling me is that is not behavior that I like, because what that's telling me is a price that was previously too cheap or too expensive to trade at is all of a sudden an accepted price. And so it's kind of lingering there. And what happens generally is when the market revisits a low volume node that it ran through before, it tends to create, on the next time it goes up there, if it doesn't reject it again, it tends to create a high volume node, or what it'll do is it'll come back and create a big fat profile right at that price. We see that over and over and over. And generally what that portends, or what that generally projects is continuation. So if this market came back up, if the ES came back up to this 91, pulled back to say the mid at 90, then went to 91 and started to trade the 91 back and forth, I am no longer interested in this trade. This behavior, the context of this trade has changed, and this behavior tells me that there's a high probability that it's consolidating, building energy, and that energy is going to resolve itself to the upside, so I'd start looking for a test of 93 and then, you know, continuation of the overall trend. So to answer your question, if I'm short an LVM or long an LVN looking for rejection and it doesn't reject, I would start to think about tightening my stop, and I'd start to think looking for an exit. Because the expectation is that the market goes to an LVN and bounces off of it. The example I use is a golf ball bouncing on a concrete driveway, which is what an LVN is. It's like a hard surface, very low volume surface, versus a golf ball bouncing in tall grass, which is this high volume node. When the market gets into tall grass, this high volume node, it tends to kind of chop around instead of bouncing right off of it, and that's just what constantly happens, and that's why I watch these volume profiles.
Okay. There was a post in the AMA thread. I can't remember the guy's name, but he was basically asking, how do you determine what time frame you should trade? You want to take a stab at that one?
Yeah, I answered one this morning about 2,000 volume chart or 25. The time frame is in my opinion, and I've messed around with like in the 13 years I've been trading, I've messed around with so many chart types and chart lengths. I've done everything from point and figure to reversals to range bars to time to tick to volume, and I'm using volume now mostly. And what I found is really it's just a function of how much detail you want. So I'm using a 2500 to trigger trades. Like, I'm looking for detail here. These bars can range anywhere from 12 to 15 seconds, or they can go on for like 9 minutes before one bar is formed, because every bar is formed once you have 2,500 contracts traded at that bar. And so the reason I use that is because I'm not interested in having another bar form if there's no activity. Since I'm trading heavily on the volume side, I'm trading price and volume but not time, I'm interested in only seeing a bar form when there's enough volume to do so. But if you're someone who's research or who has a tendency to like to categorize things in time, then you're kind of forced to use time. So to answer that question that Mike was just asking, it's really based on, and you know, I'm sure there are threads that argue one thing or the other. It's kind of like talking about religion. It's really whatever you believe. But the key element of all of that is, what have you done your homework on? If you have done your homework on 15-minute bars, and you're setting expectations for 15-minute bars, like for example, you've studied the range of the average 15-minute bar, or whatever, you kind of need to stick with that and formulate a plan around that, and then use a higher time frame to see the bigger picture, to be able to see the forest rather than seeing, you know, standing among the trees trying to figure out what the market is doing. You need to go twice that time frame. So 15-minute bars, the next one is 30, you double the 15 to 30, you double the 30 to 60, you need to look at 60 and 15 to kind of keep an eye on the bigger picture. That's just my opinion. There's no right or wrong way to trade, but trade in the time frame that you have studied, and that's what I would recommend.
And I mean, not just study, but before you study it, well, once you study it, you should be comfortable with what it's telling you, right? I mean, if it's telling you need to have a 30 tick stop and a 50 tick target, but you aren't comfortable in holding that long, then obviously that's not a good time frame.
Oh, absolutely, absolutely. I mean, setting a time frame that is unrealistic for your account size, like like trying to trade crude oil on a 60-minute bar on a $2,000 account. Forget it.
Right.
Because there's no way to determine a stop that's reasonable for that size account. I mean, it has to. That's why a lot of people say, well, I want to swing trade futures. Well, to swing trade futures, you need a decent size account because your stops are so far and you're using leverage. You have to have a much bigger account. And
patience. I think a lot of people suffer from over trading, right? So, maybe they should consider trading a little bit bigger time frame to help them out on that, to help slow things down a bit.
Slow things down, right? Take the opportunities that have the probability that go your way,
right. All right. Edmund asking, he says he's able to cut his losers short, but his main problem is he just cannot let his winners run. He's heard you and others talk about this many times, but he still has trouble with this. Is there a way to outwit himself?
Okay. So the fact that you're cutting your losers short is great. So that's an improvement over many. The issue there is that, are you cutting your losers short because you're using too tight a stop and you're going to, it's death by 1,000 cuts type of thing? Or do you have something that is balanced in that your losers are being cut short at a realistic rate? In other words, you're not using a 2 or 3 tick stop in EES and are proud that you're cutting your losers short, but then you're taking a 2 tick win. That has to be balanced. You need to balance the risk per unit of profit that you're going to take. And we can probably discuss that sometime in a future webinar or something. But as far as outwitting yourself with your winners, the only thing that I found that overcomes this is habit forming. The fact that you're unable to hold on to winners, which, by the way, you're in a group of, you're not alone in that group. It's a very, very crowded room, actually. The number of people who will often just wait for a loser to come back to a scratch, but then they'll take 3 ticks on a 9-point winner because it came back right after they entered. The only way, in my opinion, in my experience, is to form good habits, and that means discipline, right? You have formulated a plan to do something, to take a certain setup. Like this may be, for you, this may look like a W-type setup and you're looking for the long, and you tell yourself, my stop has to be below 87.25, which to me would be kind of a sucker stop because that's an easy stop to get. And then your target may be somewhere up here. You need to just, once you've done the work and the market has given you the opportunity to execute that trade, you need to execute it. You need to close your dome. You need to watch your chart if you're going to watch and let it play out. And what happens is, over time, by doing that 30, 40, 50 trades consistently, what happens is you lose that urgency to micromanage and overtrade your trades. Just like Mike was saying, it's just a habit-forming thing. It's a lot like wanting to become a sprinter. You cannot go out there and sprint right away. You can't outwit your muscles. There's a habit. It's a personality trait that you have, and many have, to be very risk-averse. Because you're not accepting the leverage in these products. And so what you have to do is just basically sprint a little bit, then more, then more, then more, and pretty soon you'll find yourself, instead of finding excuses not to go out for your sprint, you'll find yourself having the urgency to go out no matter what. And that's just changing habits, and it's just key for traders to change habits.
And just 2 very quick things. I'll say confidence in your method, and I think also consider trading size where you don't care, because the less you care about the trade, the more likely you're going to let it go. You're going to let it continue to its original target. Okay, Mike asking, I believe that I have an edge trading price action, but he has a hard time getting into trades, and he's waiting around most of the time. I'm not afraid of executing, but I wait too much and let too many trades pass. He cherry picks. Any advice?
Okay, so this is Sort of a similar problem that I think it was Edmund with the Outwitting Himself. The issue in both on both counts is this idea that is instilled in us with our education and so forth, to only take a trade when we have completely convinced ourselves that we are right. And so with Edmund, the issue was he's convinced himself he's right, he puts the trade on, but because he's taken big losses in the past and that's caused some confidence issues, he's taking trades quickly. The issue with Mike is that you really, really need to be right. So what you're doing by waiting and cherry picking and so forth, what you're doing is you're taking price risk in exchange. You're trading price risk for information. So you're waiting for the market to give you more and more and more information, to the point that price has gotten so far away from where you really want to be that you end up letting the trade pass. And then when it comes again to the area that you wanted to trade, you're waiting for more and more confirmation. Why? Because you'll only put a trade on when you're absolutely sure and have convinced yourself that you are right. And I'm going to tell you, and this is, in my opinion, indisputable, there is no way to know when you're right. Trading is not about picking the right trades. Trading is about executing consistently based on an edge that is in your favor. And that edge can be 50-50 if you want, with a better return versus risk, or it could be a high probability trade that occurs less frequently but pays out more often. Okay, so you have to execute the trades as they come.
Right. And that's why it's just not so black and white when I see people post, "Hey, I'm going to stop trading if I have 2 losers in a row." Well, I mean, you have no way of knowing your next 5 trades could all be winners, but it also could be that you're totally off your game and mentally you did a poor job, and that would be a good reason to stop. But if the trade didn't work out, yet it was a good trade, then, what does your system say, right? So, I mean, there's same thing with the cherry picking, right? What does your system say? Build that confidence, right?
Yeah, and the only way to do that is to take the edge when it shows up, period. Force yourself to do it 10 times in a row and see how that changes things.
Right. Yep. As long as your execution is what you've allowed it to be and you're not making mental mistakes, then yeah, absolutely, right? All right. Chuck's asking, he says, hey, he wants to make a living trading. Do you recommend that he joins a prop firm, a hedge fund, or just build his own account?
To make a living trading, hedge funds do not fit that bill. Hedge funds, you're either going to be selling stuff or analyzing and passing trades to a trade desk, which follows those trades. So you're not really doing any trading of your own. Prop firms would be the ideal situation, because then you don't have to worry about funding, and in most cases, although many prop firms are not run the way I ran mine and the way I think they should be run, you don't have to worry about risk, because there's someone there that is constantly kind of beating you over the head on risk. The issue with prop firms is the deals that I see out there that people often from Twitter or my website write to me and say, hey, I got a prop deal, can you look at it? The deals out there are just very, very poor, including these deals where you pay up to qualify and then they fund you and then they cut you off and you have to pay again to qualify and stuff like that. Some of you know what I'm talking about. But prop firms are few and far between as far as the spots available. If you find a prop position, that is something you'd want to look into. Be careful signing a contract without understanding exactly what your costs are going to be and what your payout's going to be. But that is the ideal situation, in my opinion. That's how I got my start. It made a huge difference as to how I developed as a trader, to be a part of a prop firm and to come in and see that other guys are, showing up, are exercising discipline, are following a routine, and are walking away with, $3, $4, $5, $15,000, $25,000 days fairly regularly. You know, it just makes you believe in what you're trying to do, and that's a huge part of it. So I think unless you find a prop position, I think you can do just as well building your own system, but I would focus on your psychology, habit forming discipline, rather than chasing signals and tools and systems.
Right. You know, I mean, there's when you talk about that one firm, the only thing, I mean, every business has an angle as a way that they make money, and that's what the business is for 9 times out of 10, right, is to make money. But I think that people also sometimes set wrong expectations. I think that it would be better to look at those types of things as a way to enforce good risk practices or good discipline, you know, at the cost of, say, $300 for their program or whatever, versus spending God knows how much of your own money in your own account without such a rigid plan forcing you to those numbers.
That's an excellent point.
Yeah, I mean, you shouldn't look at it like, hey, I'm going to spend $300 and now I'm going to have a $100,000 account to trade. That's highly, highly unlikely. Just like, you know, trading in general it's all about numbers. It takes a lot of work, and there's only a few people that are really, really good at it. And if you think otherwise, then you need a reality check just a little bit there.
and you'll get one fairly quickly in this business.
Yeah.
Yeah, you do have. I agree with Mike there. You need to set the right expectations. I'm not saying those programs are no good. That's not what I'm saying. I'm not bashing anyone's business, but what I'm saying is what I've seen is folks just go in there and they qualify, and then they throw everything out the window because they want to swing for the they want to trade they want to trade 20 lots for 3 ticks and make a lot of money. It just it doesn't work.
Yeah, and if they did that, I'm sure they would be booted very quickly out of that program, just like they would be booted out of a real life account pretty quick. Real quick question, follow up on the props. For people that are in the States, is it kind of a prerequisite that they live in Chicago, or how many props let you work from home?
You know, when I was in equities, you could trade from anywhere and still be prop. But futures in general require you to be in-house for many reasons. Like for myself, for my prop shop, I mean, you were in the room, I was next to you until you started making money. You can't move from the seat next to me, and once you do, some new person will replace you, and that's just the process that I had. And it's really because making money in trading has a lot to do with the personality, the discipline, and the habits of that person. Like the one thing I didn't like seeing, for example, is a person trades, they put on a trade, and then they pull up a website, they start surfing, their email or whatever. That's not, unless it's some swing trader or something, which I didn't back. You need to be engaged with the market. It's like driving a fast car. You can't fiddle with the radio around a NASCAR track, So, but I'm sure more and more companies are going to start offering out the remote option.
Okay.
But I don't know of any large shop like Chopper or Alston or any company like that that's offering remote trading to someone new.
Right. And if you're overseas, and I was assuming London would be the first place to start, right?
Yeah, the big shops there.
All right. LW asking, hey, how do you deal with slow-moving, grinding, low volatility market like this?
Auction-wise, the market does the same thing it would do in a faster-moving market. The only problem is that you're sitting duck for much, much longer in this type of market. And this is the kind of market that you're going to get in a rally. I don't like rallying markets, like one-way markets, because people take their positions and they sit there and there's not much coming in and out of the market. Consider these markets as a slow motion of what would normally happen anyway. And your plan really, if you've defined your risk, you've defined your targets and where you would take your entries, where your higher probability entries are, it shouldn't make a difference to you except that now you're sitting in a trade for 3 hours instead of 25 minutes. That's really the only difference it should make.
Right. SK asking about meditating. So I'm assuming he's talking about like before you start for the day. Anything on your personal list there, or anything you recommend?
I think any meditation works. I did always push my traders to meditate. It's a requirement, and I won't get into, maybe again, that's another thing we could talk about someday. But meditation really makes a difference on an experiential level. It makes a difference. It is not some riff-raff, new age nonsense. Meditation changes the way your mind works when it's done properly and for a short period of time, and it really changes your ability to perceive what, without prejudice, without emotion, or with less emotion, what the market's actually doing. I think any level of performance for any sport or any task whatsoever would be much more enhanced with meditation. I think the most popular one that I see is by this guy named John Kabat-Zinn or something like that. Check that out. It's a good way to start your day, 20 minutes in the morning, right after you wake up and do your morning business. Sit back down in a comfortable position and just close your eyes and let the thoughts kind of come in and out of your mind. And the purpose of it is to reduce the noise, the self-talk, which is why Mike cherry picks his trade and why Edmund does not let his winners go. It's because there's just too much conversation going on, and that's the most common symptom of that sort of frustration with performances. You're just talking yourself out of trades, into trades, just too much talk. You just need to be able to focus, quietly focus.
Right.
And meditation does that very, very well.
I can't remember which book, but I think there's a pretty good chance it was one of Dr. Brett's books, and I think he described one thing. I want to see if you think it's similar. Basically, where you step out of your body and look at yourself from across the room, like you're in the corner of the room and you're observing yourself, and you this is while you're in a trade, and you look for things that you're doing wrong, like you're leaning forward and your back's not touching the chair, your feet are anxious, your
anxiety,
yeah. Right, yeah. And these are all indicators, right, that you're not comfortable with what you're doing. So either you don't have the confidence, or something is not right, right? So
the restless leg, yeah, absolutely.
So do you think that that's a good? I mean, what I did, this is years ago, but I found it extremely helpful, was I used Camtasia Studio, which is a screen capture program, and I would capture my chart, my DOM, and it had the ability to do a little webcam of me, okay, like a picture-in-picture thing. And I would just flip the switch when I entered a trade, turn it off when I'm done, review that at the end of the day. Man, that was eye-opening, because you're just not aware of these things that you're doing. And once I saw it, I was like, man, I got to work on this. This is ridiculous that that I was doing these things that I knew I should not be doing. So, is it the same as Zen and meditating, or is it a different thing when you're doing it in a trade?
It's really, meditation is really self-awareness, right? It's becoming aware of what you truly are, and I think, it's funny you talk about Camtasia, and I did that. I did that a while ago, I think in 2004 or something, and I was also surprised by, but I recorded like hours of it. And what I noticed is before I enter the trade, like my eye movement and my watching of the different DOMs that I was watching, because I was trading indices against each other for scalping, was a lot calmer and slower. And then I get into a trade, and then you see my eyeballs just moving all over the place, like looking for clues, you know? And it's like, it should not change. It should not change. If I put the trade on, it should still be, that's when I should be even calmer. Yeah. So it is amazing. But as far as meditation, I don't think, it's I say this about trading all the time. Like, even if you come to trading, you give it a go, you give it everything, and you just move on and become an entrepreneur of some sort, you open a shop or whatever, the experience you gain from trading, just like the experience you gain from meditation, is not lost. It makes you, in my opinion, a better businessman, just like meditation makes you a better, more focused performer in whatever endeavor you choose to go with. So it's not something you'll be wasting your time on. And by the way, meditation requires discipline and good habit formation, which is something that you'll have to contend with as a trader for your entire life, you know?
Right. And the patience to do it.
Yeah.
And before people run out and go buy Camtasia Studio, I actually think that the newest version doesn't have that picture-in-picture thing anymore, so do some research on that. Brian is asking, what do you think about the huge backwardation in crude oil right now?
I think it speaks of the upside-down economy that we're in. There's backwardation across the board. I mean, the S&P index is trading more expensive than the futures. Just imagine you go out and mortgage your house, and you're paying your bank less than what your house is worth, and that is okay with the bank. That's essentially what we have here. So I think it's just an indication. If you're looking for that as an indication of a reversal of some sort, I think that's more of a fundamental perspective, which is outside of my realm, and I just don't have the pockets deep enough to trade anything like that, so I don't worry about it. But I think across the board, given interest rates and the cost of carry, the cost to actually carry a product forward into the future has become so cheap that you're going to see that backwardation happen on many, many commodities, including these indices. So I wouldn't use that too much as an indication of a top in crude yet.
Okay. I'm going to pick just one last question here since we're at our 30 minutes, and I'm going to encourage everybody else to go post their questions on the thread, and FT will take a look at them later. I'm picking this question because I think it's a very common and popular question. So Max asks, what do you think about wasting money on a trading room?
Wow.
That's his words, wasting money.
Yeah, he cuts to the chase there. I don't want to risk offending everyone that may be running a trading room or so on, but I will say this. You will know fairly quickly by being in someone's room, chat room, trading room, whatever, you'll know fairly quickly whether or not it's something that is for you and if it's real. The question that people ask when they go to chat rooms is, does this guy make money? And if so, how much? Because they think that if he makes money, then I should listen to him because I'll make money because it'll rub off through the knowledge he's sharing. He or she's sharing. But that is not true. What you have to look at is, am I a better trader by being in this room? Do I find that I'm enhancing my trading? Do I find that I am taking better opportunities, I'm more disciplined, and I have the community I need to feel connected with the market and everybody else? Or is this just a distraction? Are they playing music all day long? Are they just BSing all day long?
Right.
The fact is, when you're trading, think of yourself as someone who's driving a very fast car around a track. You need to focus like your life depends on it. And if a chat room is providing feedback that promotes your trading and allows you to be more disciplined, fine. But if it's not, then you are wasting your money.
Yeah. And I'll say a few things that, FT probably doesn't want to say, doesn't want to get in trouble. But, running the forum for 4 years, I see this come up, a zillion times. People love trading rooms. Let me just say a few things that you should be extremely careful of that I've noticed patterns, right? I don't belong to any rooms. The results that they're claiming during the room are false, inaccurate. I would go as far as to say most of them are flat lies, in my opinion. And this is based on what they post later, like on their website. A lot of these websites are really notorious for having these beautiful Excel spreadsheets of how much money they're making. And if you are watching a lot of these rooms, not all, this is very clear, not all. Unfortunately, it is most. Then they have this tendency, right, where they claim that they called out a trade, but really they didn't. It would be more like, oh, this might be a good place to get long, and then if it worked out, then they will book that as a winner.
then they're scaling out.
Right. And the same thing for the losers. They won't record a losing trade because they may have worded it in the room something to the effect of, well, that was for advanced traders, or these are the kinds of things you got to be extremely careful of. So I would highly recommend, this is me personally begging you guys, if you're interested in trading rooms, please do not go there in order to get some type of a signal calling. I think it's a much better way.
I was going to mention that.
Yeah, if you can find a room that de-emphasizes the signals and instead emphasizes all the other important aspects of trading, like the patience and the discipline and the risk, and especially if you're a really new trader and you just need some help with terms, if you find a room that's good for that, then those things could be helpful, in the right environment. But you've got to be so careful that you don't get hung up on the signals or what they're telling you for their reasons to enter or exit a trade if they're not being truthful with you at the end of the day. If you just write it down. Just make a little note yourself, right? Of what you believed was a trade, and let's see what they say, what they think was a trade at the end of the day.
So ultimately though, Mike, the fact is, and this is just a fact, there is no right or wrong way to trade the market, and there's so many ways to cut this thing.
Sure.
If you're trading someone else's signals, this is just like buying that brand new car and then giving someone else the keys to drive it around while you stand at the sidewalk watching. Yep. Don't be dependent on someone else's signals. You can never be a professional. You can never make money at this. I've never seen anyone make money on someone else's signals.
Right.
The idea is whatever time you invest it learning how to be independent as a trader. That's key.
Yeah, and you said something else at the top that was I thought very important, that too many people place that emphasis on whether or not somebody else makes money in order to determine if they're going to listen to them or not. And it goes hand in hand with what you just said. So you got to, so you can learn a lot from somebody that's a bad trader, because you can learn a lot of what not to do. And if they're a good trader, that doesn't mean you're going to be a good trader too. So it's worth repeating this over and over again, because I see people get caught up in this, and it's a cycle. And I see people that have been the members of BMT for 4 years, and the only threads they participate in are these trading room threads. And I know I'm going over the time limit here, and I'm preaching and all that, but guys, this is something that I feel it's very important. You should not fall into that cycle, because it's hard to get out of that dependency. You got to think for yourself. You got to do your own research, make your own trades, not someone else's.
And many will fall for that, and that's okay too, because it just means you prolonged and made your education more expensive. Eventually you will find out that what's being said by Mike is the truth. It just means you're kind of spending more of your resources and time, especially time which we cannot recover, to figure that out. So in either case, you'll find out what works and what doesn't for you.
Yep. All right, man. As always, I want to thank FT for his time today, and we will see him back in 2 weeks, which is, what is that, August 6th, Tuesday, August 6th. So thanks, FT. I'll post the recording of this AMA in the thread later today. You guys can check it out there. Thanks
for having me. Take care.